Hello everyone and welcome back to Explain the Charts, your go-to channel for in-depth market analysis and unbiased predictions on key financial instruments. Today, July 24th, 2025, we are taking a deep dive into one of the most liquid and actively traded currency pairs, EURUSD, the euro against the US dollar, which currently commands significant attention. Based on the latest news and market sentiment gathered, EURUSD is exhibiting defensive behavior just below the crucial 1.1800 level, yet it's firmly entrenched in what technical analysts describe as a bullish consolidation phase. Recent reports highlight that this particular rise in EURUSD can be largely attributed to the persistent narrative of elevated US inflation, which tends to put downward pressure on the US dollar by affecting its purchasing power and future interest rate expectations. Adding to this, the US dollar has shown a continuous sell-off trend as the market anticipates next week's highly awaited Federal Reserve meeting, a key economic event that naturally provides a tailwind for the euro by creating a relative strength. While the exact details of the European Central Bank's most recent decision aren't fully outlined in the provided snippets, its immediate impact appears to have caused the dollar to trade somewhat sideways against the euro, indicating a period of cautious reaction and perhaps a lack of strong new directional conviction from the ECB itself. Despite this momentary pause in definitive direction from the ECB, the prevailing sentiment among Forex traders seems to be solidifying their conviction in the euro's near-term strength and potential for further gains, especially against a weakening dollar. Looking at broader historical data, platforms like Wise.com confirm that the euro has significantly strengthened by 0.54% over the past month, showcasing its recent resilience and upward momentum. Even more impressive, over the last 12 months, the euro has appreciated by a substantial 8.25% against the US dollar, highlighting a powerful underlying trend that has been building over time. This substantial long-term appreciation is a critical fundamental piece of our puzzle, suggesting a foundational strength in the euro. We will now explore how these fundamental forces manifest on the actual price charts across different timeframes, looking for technical confirmations and trading opportunities. As we zoom out to the daily chart for EURUSD, the pronounced bullish narrative that has unfolded over the past year becomes immediately apparent, painting a clear picture of sustained euro strength and dollar depreciation. Starting from a significant bottom established around 1.03 in early January of 2025, the pair has embarked on a sustained and impressive uptrend, steadily gaining ground for several consecutive months without major reversals. This consistent upward trajectory visually confirms the substantial 8.25% appreciation against the dollar, directly aligning with the robust long-term trend reported in our news segment, providing a clear macro view. Our initial analysis reveals a crucial long-term support zone firmly established around the 1.03 to 1.04 price level, which marked the lowest point of the past year and served as a strong foundation for the subsequent rally. Following this pivotal low, the market demonstrated significant strength by decisively breaking above previous resistance levels, most notably the 1.08 to 1.09 region that had acted as a formidable ceiling throughout late 2024, absorbing significant selling pressure. This decisive move confirmed a shift in market control from bears to bulls, signaling that new higher lows were consistently being formed, a classic sign of an ascending trend. A particularly powerful bullish impulse was observed in early April 2025, characterized by large-bodied green candles that shattered the 1.11 to 1.12 resistance area, initially established in August of the prior year, with significant conviction. This strong breakout candle, specifically on April 10th, saw a remarkable 2.8% surge in a single day, indicating aggressive and widespread buying interest that overwhelmed sellers. The very same 1.11 to 1.12 zone has since transformed into a robust psychological and technical support, with subsequent pullbacks retesting and holding firm at these critical levels, underscoring their importance and validating the new uptrend. The momentum continued relentlessly, with the rally extending strongly into June, pushing the pair confidently towards the 1.16 to 1.17 region, thereby solidifying its recent gains and demonstrating sustained buying power across the board. This consistent upward movement, coupled with healthy and often increasing volumes on bullish candles, suggests strong conviction among buyers on the daily time frame, supporting further upside potential. As of our latest data, ending on July 23rd, the price is actively testing overhead resistance just below the 1.1800 mark, specifically closing around the 1.177 level, which aligns perfectly with current market commentary about trading below this key psychological level. The highest point recorded on July 1, 2025, reaching 1.18303, serves as a clear confirmation that this 1.1800 to 1.1830 band represents a significant resistance area that determined buyers are currently attempting to decisively conquer. Breaking past this key level could open the door for further substantial upside, making it a critical juncture for this pair, potentially leading to new yearly highs. Traders should certainly note the increasing volume on bullish candles in the recent uptrend, indicating strong accumulation and sustained interest. Now, let's zoom in closely to the 15-minute time frame to scrutinize the very recent price action that directly precedes today's reported market sentiment and provides finer, more granular detail for short-term traders. Within this narrow window, spanning from July 22nd into the late hours of July 23rd, we can vividly observe the bullish consolidation mode that market analysts have been highlighting, particularly as it pertains to immediate trading opportunities and short-term volatility. The price has largely fluctuated within a relatively tight range over the past 24 hours, consistently maintaining support above 1.173, despite showing minor higher highs and generally trending upwards in microtrends, which suggests underlying strength. However, it's evident that each upward push is met with discernible resistance as the pair attempts to challenge the 1.178 price point, forming a clear, albeit temporary, ceiling in the immediate short term. Observe the prevalence of small-bodied candles, often with long wicks indicating indecision and whipsaw price action, and the oscillating, choppy price movements, which perfectly reflect the dollar trading sideways narrative mentioned earlier. Transaction volumes within this short-term consolidation period appear moderate, neither exceptionally high nor extremely low, suggesting that neither buyers nor sellers are currently demonstrating overwhelming conviction, leading to a balanced struggle for control at these levels. The lowest point reached during this specific 15-minute filtered range was approximately 1.1685 from July 21st, confirming that even with minor pullbacks, the underlying bias has remained upward, albeit with less explosive vigor than on the daily chart. The continuous pressure experienced just below 1.1800, as emphasized in the news, is tangible here, with repeated attempts to breach these higher levels frequently resulting in immediate, albeit minor, pullbacks from profit-takers who are likely scaling out. This current short-term behavior strongly implies that while the broader, longer-term trend remains unequivocally bullish, immediate upside momentum is currently being constrained by a combination of strong overhead selling interest and cautious profit-taking activities at these elevated levels. Therefore, patience is crucial for short-term traders awaiting a clear, high-volume breakout above 1.178 or a definitive breakdown below 1.173 before committing to a strong directional trade, as false breakouts can occur. Maintaining awareness of these intraday price dynamics is essential for pinpointing optimal entry and exit points. Transitioning back to the daily chart allows us to contextualize these short-term movements within the grander scheme, enabling a comprehensive overview of both the bullish and bearish arguments for EURUSD going forward into the coming weeks and months. On the decidedly bullish side, the foremost catalyst remains the pervasive US dollar weakness, consistently fueled by persistent domestic inflation concerns and the market's anticipation of a potentially more dovish monetary policy from the upcoming Federal Reserve meeting, possibly leading to rate cuts or a slower pace of hikes. This fundamental backdrop provides strong, sustained tailwinds for the euro, making it fundamentally more attractive relative to the dollar and drawing in capital. The historical price data unequivocally supports a robust and consistent long-term uptrend for EURUSD stretching back to the early months of 2025, strongly indicating that any temporary dips are widely perceived as prime buying opportunities by long-term participants, forming a buy-the-dip mentality. A critical technical reinforcement for the bullish case is the successful and validated break above the 1.11 to 1.12 major resistance zone, which has now convincingly transformed into a solid support level, further bolstering the euro's inherent strength and establishing higher lows in the broader trend. Moreover, the consistent and often elevated trading volume accompanying significant bullish moves on the daily chart points towards strong underlying institutional and widespread retail buying interest, adding substantial credibility to the rally's sustainability and indicating conviction behind the moves. However, the primary bearish argument for EURUSD currently revolves around its persistent struggle to achieve a decisive and sustained break above the formidable 1.1800 to 1.1830 resistance zone, suggesting a strong supply wall that has so far repelled higher prices. Should the European Central Bank's future policy announcements, or indeed the Federal Reserve's actual stance next week, prove to be less dovish than what the market has currently priced in, we could witness a swift and significant US dollar rebound, consequently pushing EURUSD lower due to unexpected shifts in interest rate differentials. A clear and sustained rejection from the 1.1830 ceiling, especially accompanied by high bearish volume, would likely precipitate a short-term bearish reversal, with potential targets for immediate support identified at the 1.17 or even the 1.16 price levels. Another crucial bearish indicator would be a noticeable and sustained decrease in accompanying volume during any subsequent daily upticks, signaling a potential exhaustion of buying pressure and a worrisome lack of conviction from market participants, making the rally vulnerable. To thoroughly recap our in-depth analysis of EURUSD, let's now synthesize the most critical takeaways and outline our forward-looking market outlook with a focus on actionable insights for your trading decisions. The overarching long-term trend for EURUSD remains unequivocally bullish, robustly supported by a prevailing narrative of persistent US dollar weakness, a trend that is clearly depicted by the series of higher highs and higher lows on the daily chart since early 2025. Key immediate price levels for traders to meticulously observe are the formidable resistance band at 1.1800 extending up to 1.1830, a zone that the pair is presently actively testing with strong determination, as seen on shorter timeframes. A decisive breakout and sustained position above 1.1830 would signal a powerful continuation of the strong bullish trend, potentially propelling the pair towards the 1.19 or even the 1.20 mark in the short to medium term as new buyers step in. The likelihood of this bullish scenario materializing is assessed as moderately high, approximately 65 to 70%, particularly if the upcoming Federal Reserve meeting confirms a more dovish monetary policy stance, or if subsequent U.S. economic data continues to exhibit signs of underlying weakness, reinforcing the current narrative of dollar depreciation. Conversely, the primary major support levels for EURUSD are found initially around 1.17, which serves as a first line of defense, followed by an even stronger confluence of support within the 1.16 to 1.162 range, which historically aligns with significant previous consolidation areas and robust volume profiles, making it a crucial rebound zone. A sustained break below the 1.17 level, and especially a breach of the critical 1.16 support, would strongly indicate a short-term bearish reversal, potentially leading the pair to retrace towards 1.15 or even lower, challenging the integrity of the broader uptrend, with about a 30 to 35% likelihood under unexpected hawkish news or Eurozone weakness. For short-term traders, it is paramount to closely monitor the minute-by-minute and hourly behavior of EURUSD within the tight 1.17 to 1.18 range, diligently searching for clear, high-volume breakouts or definitive breakdowns as decisive entry or exit signals to avoid getting caught in chop. Long-term investors, on the other hand, would be wise to maintain their existing positions while vigilantly monitoring the 1.11 to 1.12 support level on the daily chart, as a sustained breach below this crucial floor could indeed signal a more profound and lasting trend reversal, necessitating a reevaluation of their overall strategy and risk exposure. Upcoming economic reports from both the Eurozone and the US, coupled with further central bank communications, such as any shifts in ECB rhetoric, will undoubtedly serve as pivotal catalysts. So staying informed on these developments is absolutely essential for making timely and informed decisions. Always remember to meticulously incorporate robust risk management principles, including setting clear stop losses and managing position sizes appropriate for your risk tolerance, into every aspect of your trading strategy. The dynamic nature of Forex markets means conditions can shift with remarkable speed and volatility, making disciplined risk management your most valuable tool. Thank you for tuning in and joining us for this comprehensive analysis on Explain the Charts. Be sure to like this video, subscribe to our channel for more expert insights, and hit that notification bell so you never miss our in-depth market breakdowns and future trading opportunities.